Now, for everybody's favorite topic, taxes and taxation, understanding how it is that operates. So what are taxes? Well, that's going to be the government getting money from you. All right, you may not like taxes, but if you want a government that does something, anything, police, schools, fire departments, roads, whatever, then you're going to want some sort of taxation in order to be able to pay for it. All right? Now, the government brings money in that is called tax revenue. So when you pay taxes, sales taxes, whatever, that's going to be tax revenue for the government. Now, this just gives you some information right here as far as terminology. You got balanced budget. This is going to be when the tax money coming in is equal to the money going out, right? So the government is only spending as much money as it brings in through taxes. A budget deficit means when it is spending more money than what it brings in through taxation for that year. A budget surplus is the other way around. The government brings in more money than what it has to pay out, and it's spending. And then overall government debt is going to be when the government is, over time, building up debt, right? So not just a deficit for 1 year, but over a number of years. So if you add up all the deficits together, then you would have the overall debt, generally speaking, right? So this is all the money the government owes. A deficit is going to be how much money the government has borrowed in just 1 year. The debt is how much it owes overall. Now, where does the government, at least the federal government, get the authority to tax you? It's actually in two different places. Now, the Constitution provides it rather quickly. If you remember the Articles of Confederation, one of the weaknesses there, that was our first attempt at government. It didn't give the national government the ability to tax. So one of the first things that Congress is given the power to do in the Constitution is to tax. So this is Article 1, Section 8, Clause 1. And Article 1, Section 8, this is where Congress is given all sorts of powers and authorities, right? So you'll learn this when you take government. Pretty sure you learn it in government. Anyway, but if you look at Article 1, Section 8, Clause 1, the very first thing it says is Congress shall have the power to lay and collect taxes, duties, imposts, and excises to pay the debts to provide for the common defense and general welfare of the United States, but all duties, imposts, and excises shall be uniform throughout the United States. That's basically a fancy way of saying the government has the ability to tax and the government to spend as long as it's supposed to be for the common defense and general welfare of the United States. That stretches quite a bit. And the uniformity just means that everybody gets charged the same, although there are exceptions. Okay, now there are certain things the Constitution says that can't be done. All right, so can't charge some states different taxes than another one. All right, you can't tax churches because of the First Amendment. Can't tax exports, that's specifically said. Taxes got to be for the general welfare. There are certain things states can't do also. So Article 1, Section 8, Clause 1 is the first place in the Constitution where the authority to tax is given to the federal government. The second place, which you need to know, is going to be the 16th Amendment. The 16th Amendment was passed in 1913, and this is where the income tax got authorized. Before this, taxing income was not constitutional. So the 16th Amendment says very simply, the Congress shall have the power to lay and collect taxes on incomes from whatever source derived without apportion among the several states and without regard to any census or enumeration. 30 words in that amendment, and this is where the federal government gets over a half of its yearly revenue from. Close to $2 trillion in taxes is the result of that 30-word amendment passed in 1913. All right? So the federal government is growing, is outstripping the amount of money that's bringing in through taxes. They wanted more money to be able to spend for everything they want to spend money on. All right. Now, of course, when they get more money, that just means that they spend a whole lot more, right? So it did pay for more stuff, but then they just spent more than what they had the money for anyway. Right, even with the income tax. It's kind of interesting, actually, when you look at the income tax. It was originally advertised as being on the rich. Don't worry, only the rich will ever pay for this, and don't cry for them, because it won't be all that much. So if you look at this, it was originally passed in 1913. So I have it here. Originally, the highest tax bracket was only 7%. All right? So the maximum amount you would ever get taxed would be 7%, and that was only on income that came in over $500,000 per year, which in today's terms is almost $13 million. All right? Whereas if you look at now, the highest tax bracket is 37%, and that is on income over $500,000 in today's money. So it accelerated quite a bit, and you get charged 35% on any income you make over $200,000. So maybe it started on the rich, but now it's on everybody else. The highest tax bracket ever we had was in 1945, and that was a 94% on incomes over $3 million in today's terms, right? Which, well, that's quite a bit. And also in incentivize people to cheat a whole lot, or to arrange their finances in such a way to get around it. Okay. Now, tax base is what is getting taxed. If you're talking about income tax, the tax base is income. Property tax, the tax base is property. Sales tax, the tax base is sales. Government's love for their tax bases to increase. That's what a strong tax base is if you've got lots of sales or lots of expensive property, because what does that mean? Well, it means more money for the government. Okay. Now, there are different types of taxations. We call it tax structures. You can have proportional taxation, and this has to do with the amount of money that is taxed, the percentage of money that is getting taxed. Let's not say amount, let's say percentage of the money that is getting taxed of your overall income. All right? So proportional taxation means that everybody is taxed the same percentage no matter how much money they make. So here, let's say somebody makes $30,000 a year, somebody else makes $500,000 a year. We're going to tax both of them at 10%. Now, the person making more money is going to be paying more in taxes also, right? $50,000 versus $3,000. However, it's the same percentage of income. So it's called proportional taxation because everybody pays the same proportion. All right? In this case, 10%. Progressive taxation is the concept where the more money you make, the higher percentage you pay. All right, so let's say you have a person making $30,000 a year, they pay 5%, and you have the person making $500,000, and they will pay, what did I say here, 20%. All right, so the more money you make, the bigger percentage you pay. Now, you've got that. You also have regressive taxation, which is the less money you make, the bigger percentage you pay. And the more money you make, the smaller percentage you pay. Now, if you're looking at that and you say to yourself, well, that just seems totally unfair that the poorer person has to pay a higher percentage. Well, you pay this sort of tax all the time, all right? A regressive tax, a good example of this would be sales taxes, all right? So everything you buy, let's say you and a really rich person buy the exact same television, you both pay the same amount of money in taxes, in sales taxes. But for you, the sales tax money represents a far larger percentage of your income than what it does for that really rich person. All right, so sales tax is considered a regressive tax. Okay, so you pay it all the time. So here are, you can see what the average sales tax rate is in each one of the states. So you see Texas is number 13 in sales taxes. We typically rank higher in sales and property taxes because we don't have state income tax. All right, and that's an average tax. So the way that it works in the state of Texas is that the state has a 6.25% sales tax, and then local jurisdictions can tack on another 2 points over that. So it will never be lower than 6.25 anywhere you go in Texas, but will never be any higher than 8.25. All right, this shows you how much states rely on sales taxes. So of the overall revenue that each one of these states brings in taxes, it shows you the percentage that is sales tax. So for the state of Texas, 34% of the state's overall tax revenue comes from the sales tax. All right. So there we have regressive, progressive, proportional, and examples of each one of those taxes right there. Okay, now good tax, simple, efficient, certain, equitable. Some are not. Right? Sales and property taxes are fairly simple and straightforward. They're fairly efficient, doesn't waste money, fairly certain. You can argue about whether or not they're equitable, right? And here's the problem: is the equitability, the fairness is the big problem, right? People don't agree on what fairness is. This is kind of one of the root causes of lots of problems within politics. Is that everybody says the word fairness does not mean that they all mean that word in the exact same way. Okay. So who pays taxes? Well, I mean, sooner or later, it all comes down to you. You can tax businesses and corporations, but this is going to come down to the individual. It either means that they're going to pass the tax on to you in the form of higher prices, or it means they have less money to pay their workers, or less money to pay their shareholders and owners, or less money to reinvest in the company, fewer people they can hire. I mean, all sorts of different ways. It's going to come down to the individual some way or another. Okay. Now you might think only in terms of federal income taxes. Well, no, right? Most states actually have a state income tax. Fortunately, the state of Texas does not. It is one of only 7 states without a state income tax. The other ones being those guys. So Texas State Constitution more or less bans it. You'd have to amend the Texas State Constitution. Last legislature made it a little bit more difficult than what it would have been otherwise. Okay. You also have FICA, Federal Insurance Contributions Act. This is when you got that first paycheck and you're really excited and you knew how many hours you worked and how many you were getting paid per hour, and you did the calculations and you're looking for that number on your paycheck and you got the paycheck and you're like, what's going on here? The number's a whole lot lower than what I was expecting. Well, income taxes are probably taken out. Plus, you also have Social Security and Medicare. Combined, that is FICA, right? You may have just had in your pay stub, it just said FICA by itself, right? Social Security is 6.2% of your paycheck. So 6.2% of all of your gross wages, the overall top line number, goes away for Social Security, okay? That's not refundable or anything like that. And Social Security has its own issues. We'll get into it at a later point in time. We'll see if that money is even still sticking around for you when you would be eligible to collect it. All right. So 6.2% goes for that. And then another 1.45% goes into Medicare. All right. Now, that's, 7.65% of each one of your paycheck goes to Social Security and Medicare. That's not coming back at you, at least not for a long way, very indirectly. Right? The money that goes out of Social Security now from your paycheck goes directly to recipients, right? People who are currently collecting Social Security. Now, one of the things you may not realize is that whatever money you put into Social Security, your employer actually matches. So if you put $20 into Social Security, all right, or Medicare, your employer has to throw in another $20. And that's not really coming out of your employer's pocket. Really, from your employer's perspective, that's a cost of having you as an employee. So really, that's part of your wage, and you're paying both sides of it, even if you don't realize it. If you're self-employed, you really are paying both sides. You got to pay the employer's and the employee share. Okay, now that's the withholding, but you got plenty of other stuff. Businesses might have to pay unemployment taxes, which is also kind of part of your wage. You have excise taxes, and excise tax, which you need to know, is a tax on the manufacturer of a good or service. So many times this just gets passed along to you. So an excise tax really doesn't do much more than increase the price of whatever it is that you're paying. All right. European countries will have a variety of this. They call it VAT, value-added tax, which is just a different type of sales tax. If you ever traveled abroad and you're like, oh, well, I'm not paying sales taxes there. Yeah, you are, buddy. It's just incorporated all already into the price of the good, right? Don't think just because the price you pay at the register is the price that was on the price tag on the shelf. All right. No, you're really still paying a type of sales tax. But an excise tax is on the manufacturer of the good, and then the manufacturer really just passes that along to you in the form of a higher price. So you can have it all sorts of things. For example, gasoline taxes. This shows you what the gasoline tax is in each one of the states per gallon of gas. So in the state of Texas, you will pay 20 cents per gallon of gas tax, right? And that is on top of an 18.4 cent federal tax. This is cent, not percent. So that means for every gallon of gas you buy, 38.4 cents of the overall price that you're paying is actually taxes to the federal and state government. You'll go over there and you look at California, man, 62 cents per gallon. All right, that means if somebody fills up with 10 gallons of gas, all right, they're paying $6.24 in tax to the state of California. If they fill up with 20 gallons, they're paying about $12.50 in taxes. And that doesn't include the federal tax on top of that. Yep. Or let's see, tobacco taxes on different types. So this is the current tax per packet of cigarettes in each one of these states. You'll notice kind of over here, right, the tobacco growing states, the taxes tend to be a whole lot lower. All right. Interestingly, these create different tax distortions where people will travel out of state in order to get their cigarettes. They just stock up, right, and then travel back, right? New Yorkers apparently do that a lot because they pay lots of taxes. Ooh, this shows you the percentage. I find this interesting. Each one of these states, the percentage of smuggled cigarettes that count as the cigarettes consumed. So New York, over half of the cigarettes that New Yorkers consume are smuggled into New York State from other places because the tax is so high in New York. Right? In Texas, it's 31%, right? The ones who have negative numbers, that means that the cigarettes are actually getting smuggled out. All right. Ooh, let me see here. Oh, now you might think, oh, vape. Well, lots of states are instituting vaping taxes also, either on the equipment or on the vaping juice, the cartridges. So they're coming around and taxing that stuff as well. Right? Or excise taxes on beer that's produced. These are the excise taxes on the production of each gallon of beer in each one of these states. So fairly high down there in the southeast. Apparently Wyoming, they like their booze. They make it cheap in all sorts of ways. Yep. Oh, this shows you the excise tax on each gallon produced for wine. Right, again, 20 cents there in Texas. You can look at the other states. You can just pause it and pay attention to that if you're curious. Right, distilled spirits. These would be liquors, right? Wine, or excuse, not wine, but whiskey, rum, that sort of thing. So Texas there, $2.40 per gallon of distilled spirits produced. And since this is becoming legal now and is also getting taxed in many places, well, in a few places where it is legal or quasi-legal, the taxes they have put on that, right? So if you look at Colorado, 15% excise tax, 15% sales tax, so basically a 30% tax on that production. I'm not sure on how they measure that. It's going to be, I would assume it's based on weight. No, there's somebody out there watching this right now. If you got this far, you're like, oh, I know exactly how much, and that's concerning. But other taxes you might pay. You got property taxes. This is an annual tax assessed on the value of the property. So let's say here, state of Texas, 1.69%, right? So that would mean that if your property is valued at $100,000, you would pay 1.69% of $100,000, which is what? For $1,690, right, in property taxes on a yearly basis. Now, you'll notice, again, it's higher in Texas, but this is because, again, we don't have an income tax. So that means we have higher sales and property taxes in order to make up for it, right? Whereas states that have higher income taxes, they typically have lower property taxes and lower sales taxes. This shows you the percentage of overall state revenue that each one of these for property tax makes up. So Texas gets about 45% of its overall tax revenue from property tax. All right, you got estate taxes. This is also known as the death tax. So when you die, your estate, everything you own, whatever it's valued at, that could be taxed. So if it's worth over, I believe the current exemption is $5 million, then it would have to pay a tax to the federal government. So even when you die, you can still want to pay taxes. Right? And you might think to yourself, well, okay, I'll show you this. This is per state, but some states have state taxes as well, right, in addition to the federal state tax. And you might think you can get around it by giving away money or giving away your state before you die. No. There's also a gift tax, which is there specifically to get people who try to get around it. So you can give away a certain amount of money to any individual per year. Any amount over that is taxed, right? And it doesn't just have to be money. It could be an item of value. So I think the exemption right now is $12,000. Anything you give to somebody else over $12,000, the amount over $12,000 is taxed. And here's the thing. That 16th Amendment, you remember that, said it can tax income from whatever source derived. It doesn't matter what. If you have game show winnings, guess what? That game show winnings counts as income, so you owe taxes on the income. So if you win a Showcase Showdown and the price is right, you can't even get the prizes in the Showcase Showdown until you pay the taxes you would owe on it, right? Or if you win money in Jeopardy, they'll take the money right out of that before they give you the money. Yep. The taxes out of it before they give you the money. Or let's say you are given money on a talk show or given prizes on a talk show, or because they'll do this where they give stuff. Oprah one time gave everybody in the audience a car. You owe taxes on the value of that car. In fact, when Oprah did that once, a bunch of people sold the car because that was the only way they could afford to pay the taxes that they were going to owe for having received the car. All right? Or gambling winnings also. If you win over a certain amount of money at a casino, the casino will send the money off to the IRS that they think you owe before they'll give you the rest of it. All right, so income from whatever source derived. Even illegal income, although that typically doesn't get reported on taxes, so that does get reported. But technically it is taxable income. This is why you look like Al Capone. He didn't get convicted for murder or prostitution or racketeering or any of that other nasty stuff he did. No, he got busted for tax evasion. They proved that he was making a certain amount of money, wasn't paying taxes on it, and so that's what he went to prison for. So income from whatever source derived, that old income tax. Okay, that's it.